What is up for a special Pop Culture Jungle where we are going to go ahead and we're going to listen in on the we're going to listen in on the Walt Disney World's first financial conference call for the year 2025.
The Walt Disney Company, not the Walt Disney World.
Yes.
I'm here.
He's here. You could have stayed on the screen at that point.
You usually introduce me.
You already introduced yourself by jumping in.
I'm here.
This is going to be a little bit of time. We have Justin's kind of scrolled through a couple of pages to get familiar with some of the items going on. I haven't looked at any of this. I don't know any of it yet. I'm assuming this is going to probably be about an hour of their call. So for us, it's probably going to be hour and a half because we'll probably pause along the way. So with that, let's go ahead and...
I forgot to mirror my camera.
You
unmirror my camera.
Let's go ahead and jump into it. I'm just double checking. No other host at this moment wants to come in. And...
to the Walt Disney Company first quarter 2025 financial results conference call. All participants will be in listen-only mode.
Oh, the call is only 32 minutes.
If you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. To ask a question, you may press star then 1 on your telephone keypad. And to withdraw your question, please press star then 2. Please note, this event is being recorded.
There should be
I would now like to turn the conference over to Carlos Gomez, Executive Vice President, Treasurer, and Head of Investor Relations.
Because then they
Please
don't
go
have
ahead,
a
sir.
camera and not just behind a mic.
I suppose, yeah.
Good morning. It's my pleasure to welcome everyone to the Walt Disney Company's first quarter 2025 earnings call.
Who is that?
Our press release, Form 10-Q, and management's posted prepared remarks were issued earlier this morning and are available on our website at www.disney.com/investors. Today's call is being webcast, and a replay and transcript will be made available on our website after the call. Before we begin, please take note of our cautionary statement regarding forward-looking statements on our investor relations website. Certain statements on this call, including those regarding our expectations, beliefs, plans, financial estimates and prospects, trends, outlook and guidance, and other statements that are not historical, may be forward-looking statements under the securities laws. We make these statements on the basis of our assumptions regarding the future at the time we make them, and do not undertake any obligation to provide updates. Forward-looking statements are subject to risks and uncertainties. Actual results may differ materially from the results expressed or implied in light of a variety of factors. These factors include, among others, economic or industry conditions, competition, execution risks, the market for advertising, our future financial performance, and legal and regulatory developments. Refer to our IR website, the press release issued today, and the risks and uncertainties described in our Form 10-K, Form 10-Q, and other filings with the SEC for more information about key risk factors. A reconciliation of certain non-GAAP measures referred to on this call to most comparable GAAP measures can be found on our IR website. Joining me this morning are Bob Iger, Disney's Chief Executive Officer, and Hugh Johnston, Senior Executive Vice President and Chief Financial Officer. Following introductory remarks from Bob, we will be happy to take your questions. So with that, I will now turn the call over to Bob.
Good morning. Before we turn to our results this quarter, I want to take a moment to express our continued sympathies to all those affected by the devastating wildfires across Southern California, including our own employees, creative partners, and so many others.
Are you doing anything to help the employees who are struggling?
Our company's roots run deep in Los Angeles, and we feel a strong sense of obligation to support the community that has helped make this company what it is today. I'm proud of the many ways our employees have stepped up to assist their neighbors in need, and Disney remains committed to helping with recovery efforts while our community rebuilds from this tragedy. Moving on to the quarter, the results in Q1 demonstrate our creative and financial strength, and they reflect the success of our strategic initiatives that we set in motion over the past 2 years. Clearly, one of the great highlights of the quarter was the performance of our film studios. We had the top 3 movies of 2024 at the global box office.
I mean, there wasn't much
And I want to
out
thank
there.
and congratulate our creative teams on such an incredible year. Looking at the rest of the calendar year, we have a lot more to come with an exciting slate of theatrical releases tied to some of our most popular IP.
Yeah.
On top of our studio's outstanding performance, we saw growth in streaming profitability, historic ratings at ESPN, and the strong and enduring appeal of Disney's experiences business. Overall, we're very encouraged by our results this quarter, and we'll be happy to take your questions.
They don't mention Thunderbolts on
Thank you.
the page.
Do they not?
No.
I-
So
I
like
think,
he's
Bob,
like
As we
reading
transition to Q&A,
paraphrased
we ask that you
versions
please
from
try
like
to
this
limit
PDF
yourself
form.
to one
Mhm.
question in order to help us get
And-
to as many analysts as possible today.
And they don't talk about Thunderbolts on here, but they talk about Brave New World, Snow White, Pixar's ELO, live action Lilo and Stitch, Fantastic Four, Zootopia 2, and then third installment of the Avatar.
All right, so let's see. We're gonna do this. So let's see what you're looking at.
I am looking at
if you
the
wanna-
executive
why don't you-
commentary.
Why don't you just go ahead and share where you were?
Oh, you know what?
That way, I don't have to turn on and off my the cast.
Here's both Mart. Let's have to do this sometime.
Oh yeah, you have to tell.
Bam! There you go. As I was saying, let's zoom in here.
Yes, please. Thank you.
Looking at the rest of the calendar year, we have an exciting slate of theatrical releases. That's where he cuts off from some of our most popular brands and franchises.
Including
I can't highlight because it's a view only.
yeah.
Cat Brave New World, Snow White, Pixar's Elio,
So we
live action Lilo and Stitch, and then Fantastic Four. Where's Thunderbolts in here?
so we just go ahead and we list them. We don't actually talk about how they're doing, or at least you haven't seen that yet.
Well, this is fiscal. Why does it matter how is it doing?
Well,
It matters if it makes money or not.
because it would matter it would matter of the cost so far into it. The expenditures into it. That is a key factor of how these are doing.
Mhm.
So we can't talk about the positives of Deadpool and Moana without knowing the bad side of Deadpool and Moana. If that makes sense.
Yes.
Deadpool was profitable because Deadpool was a very well done.
It was a
budget.
cheap movie, too.
They kept that very well under control.
Yeah.
Okay.
Okay, yeah, that's a good point.
So I'm gonna pull back to this
Yeah,
side while you
yeah.
keep digging.
And with that, operator, we are ready to take the first question.
So that's the entire
Thank you,
panel.
sir. And as a reminder, to join the question queue, please press star then 1. Our first question today comes from Ben Swinburne with Morgan Stanley. Please go ahead.
That's
That's the entire call because they said all the questions were coming at the end of the call. So there is still more to this, but the rest of this is just going over the questions.
I think they just are releasing these PDFs and then they're calling that good.
Pretty much, which is not a good sign either. But-
Thanks. Good morning. You guys have a lot going on in terms of platform enhancements this year at Disney Plus. I'm wondering, as Adam builds out his team, you work on password sharing, bundling ESPN in. What do you think will be the most impactful to driving that business, and what's realistic for investors to sort of, in terms of timeline, to expect kind of tangible results playing out in what we see in your reported.
When are we making money on
numbers?
Disney Plus?
And then I thought I would at least ask you if you could comment on the outlook for experiences in parks, in particular around the opening of Epic. There's probably no other question I get more than your ability to deliver on your guidance on the domestic parks front for the year. So any update there would be greatly appreciated.
Valid
Thank you
questions.
so much.
Thanks for your question, Ben. Regarding the timing of the different technological advances that Adam and his team are working on, they're actually starting to roll out already and will continue to throughout the next 12 months, but we're not going to obviously stop at the end of the year. I wouldn't really call out any one of them in terms of one of them having a greater impact than the others because it's a collection of them. You mentioned page sharing. That's certainly one. Using technology more and more for personalization and essentially upping our game from an algorithm perspective, getting less out of our control or curation and more basically into the business of serving the consumer what the consumer wants.
So what I pulled from that, and you can correct me if I'm wrong, is first off, they are trying to stop password sharing.
Yeah.
That was that answer was clear. That is getting ready to be rolled out. Second is realistically marketing data tracking, because they're going to try to better sell to you directly through it. Yeah,
More algorithm based, which I'm okay with.
Yes, but I also don't like people tracking my data.
I mean, YouTube does it.
No, I absolutely know.
I'm just saying, like, if we get a platform closer to like YouTube and like Spotify for like Disney streaming, I'm okay with that. Because like I don't want to see all this ESPN stuff on my homepage. I'm here for Spider-Man.
But
you know,
ESPN got approval for bidding for gambling, so they're going to try to push it anyways. It may become part of your algorithm anyways.
I don't like that.
I know. I'm in that same boat. Okay.
We've got some work to do internationally, particularly on the ed tier. Ed tech is also something that we're working on. A variety of different AI initiatives going on, and we're also developing flagship. I'd say that of all of them, one of the things that we are very, very mindful of is that home screen or front screen or the first experience that consumers have has to be more dynamic. Ours was elegant looking, but fairly static in nature. The more dynamic it is, the more people are drawn into it, the more people use it, and the more people don't basically close the app out and go elsewhere. You know, that's a big deal. But a lot going on. We're still building his team out. And I'd say
the elegant look of an app does not encourage me to stay in your app more. The content is what keeps me there. The content is the most important piece.
Okay, but it's like you have a terrible looking app, I'm not going to use it. Terrible looking, terrible functioning. Because like remember when Disney Plus launched and it was like awful to use?
Okay, but YouTube back in when it first launched was god awful, but it was still super popular because of the content on it, and that's what got it to where it is today.
Okay,
like you can clean it up as much as you want, and YouTube now is a pretty cleaned up layout because they've learned more.
Yeah,
but the main thing that's getting you there and keeping you there isn't the layout; it's going to be the content.
Yeah,
and unfortunately, right now there's not much new content coming out that's pulling people in.
Yeah,
that's where I've heard other people talk about the idea of possibly Disney going and doing more like YouTube in the process of finding Disney creators and paying them to go off of YouTube and go to Disney. So you would have like potentially Tim Tracker or whatnot be official Disney podcast, Disney like
an official Disney podcast / vlog on Disney Plus instead.
Correct. So then you would, because you already would have that market there, and then they can pull their market over with them that direction.
I can see an exclusivity deal for like, I don't see the whole brand.
No.
But like an exclusivity deal for like a show. I can see that.
Yeah.
I think that'd be interesting.
Or like a sub channel, like as everybody kind of talked about a like sub part of Disney Plus, like how you used to have, you know, the ESPN, well, not ESPN, but National Geographic and Star Wars and all that, a tab of creator or whatnot. And that would be just creator content. And straightforward, you could pay them an actual salary or whatnot, or a portion of what their views are, as long as you're paying them more than what YouTube is, and
they'll do it.
Yeah. Because you're making money on people having to pay to be on the service anyways.
Exactly.
So that kind of more so to me fixes the problem with content. Because right now, okay, how is YouTube so profitable with so much new content continuously coming out?
Ads.
They don't pay for it. YouTube is paying, 2-3 cents a view to the person who's there. They're getting paid for that from the ads that they're selling, but it's the creator themselves who's paying for the production equipment, the filming, all of that. And so that's how YouTube is so profitable, is because they can keep their expenses low on that side. Think of how much it would be for a year, we'll just go this route of it, a year of a content creator you would be paying to be there, compared to a season of The Mandalorian.
Yeah.
Or a season of The Acolyte. Like, there's such a shift there. But that is a risky move to get into, because you're trying to then pull that extra content creation over. Again, we've seen lots of rumors and talkings of it. I see that happening, probably not this year, but maybe us getting the announcement of it, and maybe being like next year or the following year.
I think they'll start with like a show first, though.
they'll either start with a show or again they'll start with like 3 creators that are pretty well established and try to bring them into it and see what they can do.
Yeah.
It'd be like when Mixer, bought Shroud. Like that entire move was to try to go and do it. Mixer just was paying too much money for every creator they brought over and killed themselves.
Yeah.
Okay. No, thank you about that. Look at you being a producer.
Say that by the end of the year there'll be significant progress made, but we've already made some progress. We've made some progress already.
Yeah, Ben, and I'll handle the experiences question. Obviously, no change to the guide that we had previously provided. We had said experiences would be up 6 to 8 on the year. The strong Q1 increases our level of confidence in the guide for sure.
Epic is going to sell. How are these people in charge if they don't understand the fact that Epic is going to sell? We cannot sit on the high horse of we're not afraid of this at all. That's not an answer.
It's obviously quite early, but we certainly feel good about the fact that we were able to power through with stronger performance than our expectations were for Q1. In terms of the balance of the year, recall the easier comps for the experiences business occur in the back half of the year, particularly in Q4. In addition to that, we obviously have lots going on in terms of our ships coming or our ship coming on as of this quarter, which will support the results from Q2 going forward. And in addition to that, as we built.
Let's see. Sorry, I just now saw you.
I just now saw those. I'm sorry.
Disney
Kevin.
Plus will bounce back in subscriber growth with Daredevil Born Again. I agree with that. And Andor, I think those are going to pull a lot of people in. And then Epic Universe is going to be successful for Universal Studios. Families still go to visit Disney parks. Yes, but we know their crowds are lower, and I think Epic's going to pull a lot of families this time because of Nintendo. I want Disney to be successful. I think Disney, though, is taking too much of a casual, like, laid-back opinion on the entire situation.
And then this is from earlier.
Was there a third one?
Yeah, Kevin asked, when do you think Moana 2 and Mufasa the Lion King are coming to Disney Plus?
That didn't even show up on my...
Probably like 3 months from now. What was it, like 3 months after digital, right? Around the same time as physical, I'd assume.
No, it said we have the physical date, but it said it was going to come later on. So I think Moana 2...
Even later than physical? That's crazy.
I think we're going to probably see Moana 2 like July.
That's
June or
crazy.
July, based on the way that everything was looking. And if that's the case, then Mufasa should
be like the month after.
Mufasa should already come out, in my opinion. It didn't pull numbers as well as they were hoping. But, yeah. Good questions, though.
Good questions. Thank you, Kevin. Thank you.
And we appreciate you hanging out.
Our plans, we did anticipate some small impact. I think we have it effectively hedged in the guides that we've given to you. So overall level of confidence in the experiences guide is high.
Thank you.
Thanks, Ben. Operator, next question, please.
Yes, sir. Our next question today comes from Robert Fishman with MoffettNathanson. Please go ahead.
Thank you. Bob, now that DirecTV and Comcast have launched their skinnier bundles and Hulu Live, Fubo planning their own, do you expect these skinnier bundles at current pricing to change the trajectory of cord cutting? Mm-hmm. And if not, what else on the pricing or product side do you plan with Fubo that you couldn't accomplish with just Hulu Live? And then if I could just take a step back, after the Fubo deal and shutting down Venue, can you discuss Disney's overall sports or broader streaming strategy with the potential for consumer confusion from all the different options, including the upcoming flagship launch? Thank you.
The goal all along, Robert, as it relates to ESPN, is to make ESPN as accessible as possible and in as many ways as possible to the consumer. Some will want to consume it just through an app. Some will want to consume it as part of the more traditional expanded basic bundle. Some will migrate in the direction of skinnier bundles or sports bundles only. I can't predict whether the emergence of these skinnier bundles is going to have a material impact on cord cutting or not, except to say that we plan to take advantage of the emergence of these bundles because it is a great way to distribute ESPN. And look, what essentially happened is after the decision was made and we started to implement the launch of Venue, the emergence of these skinnier bundles surfaced, and Venue basically looked redundant to us. And so this was a great opportunity for us to make ESPN available to multiple skinny bundles, and then to actually merge the Hulu Live and the Fubo essentially channel business as one, because frankly, while we like being in that business, it wasn't a core business to Hulu. This gives us the ability to actually enhance the Hulu Live experience because the combined entity, when it's approved, will spend more time, put more resources into the user interface and essentially making the former Hulu Live experience better for consumers. In terms of our sports strategy, I've touched on some of it, and that is make ESPN available however the consumer wants it, wherever the consumer wants it. Some will want to consume it as part of a linear channel, but we're obviously leaning into the development of what is now called flagship, which is essentially ESPN with multiple elements to it, or multiple essentially enhancements, and of course the inclusion ultimately of some form of betting and fantasy and a high degree of customization and personalization, and essentially a much bigger offering in terms of product programming than the linear channels currently offer. The plan will be to launch.
So the plan is to get things more confusing by bringing out another service. Because my understanding, and correct me if I'm wrong, my understanding was with the Fubo deal, Fubo could not be brought into Disney Plus. It was Fubo and Hulu that were becoming one. They could not, Fubo could not join Disney Plus. So the cost around the cut around of this whole thing. The question was these skinnier bundles that DirecTV and Stonks are they going to be able to battle that? And the answer is we're going to add more services to increase our bundle,
which means our price is going to go up comparatively.
Correct.
Why don't we have skinny bundles for Disney Plus?
No, because they actually, I believe it was last quarter, right before like Christmas time. If you were a new subscriber, you could book a year of Disney Plus for a fee of like $2 a month.
Oh my god!
Because they were that desperate trying to make sales. So we're seeing those as they're trying to do it.
See, like, if I could just like get all of Disney Plus except for Star Wars and Nat Geo, I'd be okay with that. And pay a cheaper fee, I'd be way okay with that.
Well, but you remember any new Star Wars stuff, and you're now going to have to watch because we're now reviewing all that.
I hate you.
Yeah, I know you do.
No.
But
no.
That wasn't a very good answer.
No, it was not.
Okay. At least it's not just me.
Sometime toward in the fall of this year. And we're actually quite excited about it because, first of all, it gives us an opportunity to bundle it with Disney Plus and Hulu. And we will get really smart and strategic about pricing there. But it gives consumers the option of basically just staying in a sports-only experience or combining it with their other services. And if they happen to subscribe to Disney Plus and Hulu, then they can experience ESPN flagship in a one-app experience, which will be both convenient from a subscription perspective and also convenient from a user perspective. So we're bullish. The other thing I want to mention about ESPN, because I know that other streamers are getting into the sports game, is we have the advantage of not only a menu of sports and sports programming that no one else has, but we're on 365 days a year, 24 hours a day. So if you're a sports fan, it's not about, one day of one boxing event or one day of football. It's about sports every single day of the year and every hour of the day. And that's a pretty compelling,
I don't know
compelling consumer proposition.
Somebody who's a fan of every sport.
Like, don't get me wrong, I've got my favorite baseball team, football team, hockey team.
But like the only sport you
Actively watch
is football.
Unless like my team is, which it never is, doing good in hockey, or like if I see a game's on and there's nothing else to watch, I'll watch
Exactly. Like there are people out there that all they do is just consume sports.
Absolutely.
And like it is a thing for people, and like I understand why he's making this point, but like realistically, it's a very small subset of people.
And the whole that we're going to be online 24/7, that makes me nervous for anybody that has a gambling problem.
Well, like what it is most of the time is it's just like those like reaction videos and like highlights.
You're gonna have those too, but
Are they saying sports 24/7?
Mm-hmm. Which
is ESPN international?
I think so.
Oh, okay, that makes sense.
But I mean, if that's the case, you go into that, and you have somebody who has a gambling problem, and they get a credit card and get on it. All they're going to do is sit there and wait for the next big win.
Yeah,
it is a business choice. I don't like the Walt Disney Company getting involved with gambling.
Yeah,
to me, I don't like that, especially with them trying to integrate ESPN. In at least originally it was. Now it sounds like they're moving away from that. But when they were trying to bring ESPN into Disney Plus, but at least them bringing them more into Hulu, it does sound like they're doing that.
I think they're gonna put, because of flagship, I think ESPN has to be its own thing.
Mm.
Because like there might be age restrictions on the app.
I hope so.
I hope so
because I don't want children to go in there and start seeing and figuring out how to gamble and such.
Yeah.
Thanks, Robert. Operator, next question, please.
Absolutely. And our next question today comes from John Hodulik with UBS. Please go ahead.
Great. Thank you. And maybe some questions for Hugh. Hugh, can you update us on the cost-cutting initiatives and how far along you are? And along with that, it looks like from the queue that you guys trimmed the content budget to $23 billion from $24 billion. Just what's behind that, and was that related to the fires in LA or just some changes to the overall budget? And then lastly, I have to ask, you have guidance for high single-digit earnings growth for the year. Started out with earnings growth of over 40% in the first quarter here. Can you just talk a little bit about sort of the cadence of the earnings growth as we look out through the rest of the year? Thanks.
Sure, happy. That's quite a few questions, but I'll take a good whack at them. First, in terms of cost cutting, as a company, we're focused constantly on identifying opportunities where we're spending money perhaps less efficiently and looking for opportunities to do it more efficiently. That's not a once a year thing. That's not a once a month thing. That's something that we do every day of the year. It's part of what a good management team does, and we do think we're a good management team in that regard. So we're going to continue to identify opportunities to redeploy money in order to make the company both higher growth and ultimately more profitable. Regarding your question on the guide overall, obviously the results were certainly in excess of expectations in the first quarter. It certainly gives us confidence, an even higher level of confidence than we probably even had before as we get into the balance of the year. At the same time, given the rapidly evolving macro environment, we think it would be premature at this point to change the guidance. That said, to the degree that the business momentum and the business performance justifies it, we're certainly not a management team that's afraid of over delivering if in fact that is where the business takes us. So generally speaking, feel better about the balance of the year, and we started out the year feeling very, very positively about it.
Thank you, Hugh.
Thanks, John. Operator, next question, please.
Absolutely. Our next question today comes from Jessica Reif Ehrlich with Bank of America. Please go ahead.
Thank you. I guess two things. One, on the NBA, can you talk about how you view the path to profitability?
Rich Ziegler, Snow White going to do better than the live action Little Mermaid at the box office? I don't know. Actually, Little Mermaid did fairly decent.
I
It wasn't great, but
I
it was
wasn't
fairly
following
decent.
numbers.
The only reason I'm not sure if that's going to be the case is at least the Little Mermaid trailers. We're still getting some pretty positive reviews and upvotes and such. Where the Snow White ones, we just talked about it last night. The second full trailer of it just got 1 million dislikes. Online hit campaign to stop Anthony Mackie, Captain America: Brave New World from making money at the box. Yeah, I don't know why people are going after him right now. I don't know if the movie's going to do well. I just haven't seen anything that made me. I'm a Captain America fan, and there's been nothing that made me excited for it. We are going to go see it. We are going to review it. We're going to do a live stream of that on the February 15th, probably about 1-ish Pacific Standard Time.
Oh, around then, yeah, probably.
And I mean, Justin keeps saying he thinks this is going to be a pretty good movie.
I think it's going to be good. I'm excited for it.
I'm hopeful because, again, Cap is still my favorite character. So I'm hopeful that this one is going to be good.
I've also gotten into like Cap a lot more this past year than previously. So like I'm excited for like the themes that they're going for.
No, yeah. It looks like there are scenes in the trailer that look good, that make me excited for it. There's still a lot of questions I have going into it, which is fine. I should have questions going into a movie. I hope it's good. I don't know if it's going to be good. We'll have to wait to see on that one.
That's a week from Saturday is our review.
That is a week from Saturday is our review.
I'm excited.
Means we might get one more little like mini trailer or whatnot next week.
We'll get a launch trailer, a release trailer. Yeah.
So we should probably be reviewing that on Tuesday too, because I imagine that should be coming out.
That'll probably be the Tuesday or Thursday before. Yeah.
Well, because they'll probably launch in theaters on Thursday, like everybody does that first day preview.
Yeah.
So
we'll see.
We'll see.
I'm excited.
Jump back into the ish.
Oh my bad.
No, you're good.
I was.
Ability.
You're zoning.
In the new contract, given the weaker season to date ratings and obviously the step up next season, and then on DTC, maybe we could drill down a little bit on how you're thinking about subscriber drivers. Bob, you mentioned password sharing crackdown. How do you think about the TAM or the potential subscriber impact? Obviously, some great films coming onto the platform later this year. And then, how important is news to the overall product offer?
In the NBA, we don't talk about profitability for any one of our licensed sports packages. We obviously believe in the NBA long term. It's a great sport. We think it's a growth sport. We don't really look at ratings year to year that carefully. First of all, we haven't even seen half a season, but we're not distracted by, in any sense, what's happening ratings-wise in the NBA this season at all. We're happy to have it for now 11 more years, including the finals 10 of those years, and it is and will continue to be a market.
Go for it.
Why are they paying for something and they're like, oh, we don't really care what the profitability is on it?
Because I think that's their go-to excuse at it, so they don't have to admit of how it's doing. And again, because the question was going at it of are we looking at the ratings and how well it's doing year to year? I might have to manually turn it off here in a second if you're cold.
I'm not cold.
Or then what was your problem?
It's hot. Gotcha. Trying to see if it was working again.
It is working. It's running. I can feel it. That's why my jacket's on. But no, they've paid for this license for 11 years.
And we're like, oh, we don't really care what the profitability is on this license. What's the point of buying it?
Yeah.
That's what I got out of that.
Yeah.
Key part of ESPN's offering. In terms of subscribers, we believe that in order for us to grow subscribers, it's really a combination of things. We have to continue to make great product, films and television series. We clearly have demonstrated over the last couple of years the ability to do that, and we are confident that we will deliver on a consistent basis high quality films and television over the long run. Second,
see.
you need really strong technology, and this is where we have, as we have said very publicly, we had a lot of work to do. And while we've made progress already, in some ways we're just getting started. The only way you succeed in global streaming, both from a subscription perspective and a profitability perspective, is with a great combination of high quality product with volume and technology. And we feel if you look at all the competitors that are in that space, we're very well positioned to both grow subs and grow profits over the long run, and actually over the next few years. We've already demonstrated the ability to make this a much more economically attractive business, and with the technology that we've got in place, combined with the success of our content, we actually are bullish about our ability to grow subs too.
And Jessica, the only thing I would add to Bob's comments are we gave you guidance in terms of the of ESPN for next year. We knew all of the aspects of the NBA contract when we made that deal, and there is nothing that is changing in our mind in that regard.
And one last thing, you asked about news. We like the opportunity to make room for our news output, both the ABC News output and the output of our local stations as part of the app experience. With improved technology, we're now offering live streams on the Disney Plus Hulu app, and news does occupy one of those streams, and it will continue to be a feature of our overall Disney Plus and Hulu offering. And
part of that whole reasoning. So I'm going to tiptoe my way through this as carefully as I can. Over the last year, ABC viewership plummeted. I think the big push of why it's now on Disney Plus and such, so I'm trying to keep look on chats and such, is to increase their viewership one way or another. So on the kids TV that your cousin was, watching Bluey and such, after so long, eventually Bluey turned off and it defaulted to go straight to ABC News.
Because that's the current live stream that's going on.
No. They weren't watching live stream of Bluey. They were watching just
regular. I know.
And so I think it's more so not necessarily. I think it's trying to help boost the numbers, because if you fall asleep or if you've left the TV on in the room,
it just defaults to the live stream
back to ABC. So all of a sudden, this viewer, because the viewer after that went on there, be it real or artificial or whatnot, all of a sudden the viewerships were going up again on ABC.
Yeah.
So that's kind of in there. I think just the ABC's still popular. Why would anybody not like it? When we've seen otherwise in
it's
real
also
numbers.
Something that differentiates us from some of the others in the space.
Thanks,
Absolutely.
Jessica.
Thank you.
Operator, next question, please.
Absolutely. Our next question today comes from Michael Ng with Goldman Sachs. Please go ahead.
Hi, good morning. Thank you for the question. I just wanted to follow up on your comments, Bob, about streaming and news. Could you talk a little bit about your decision to add the SportsCenter Daily Show to Disney Plus instead of ESPN Flagship, and with streams and SC Plus, the investments in live content? What have you found to be the benefit of live as it relates to gross ads and churn in streaming? And could you expand a little bit about the competitive advantage that Disney has in producing and distributing live relative to some other streaming services? Thank you.
Well, I think we've all seen the benefit of live. Just look at ESPN's ratings, as a for instance, or talk to anyone in the advertising business. Live is extremely attractive. And we have the benefit, as I said earlier, of having live programming every day of the week, every day of the year, or every week of the year. And so, I think that as we provide our consumers with a one-app experience, live will be a major component of basically our growth, the growth in that business. it'll contribute to the growth in that business for us. What we did with ESPN and the Sports Center show that you mentioned is we put an ESPN tile, as we call it, or presence on the home screen of Disney Plus. That was in part designed to increase engagement for Disney Plus Hulu subscribers, gives them something to see on a daily basis. And obviously, as we've talked today, growing engagement is critical, particularly to lowering churn. It also gives us the ability to use it as an introductory offer, sort of an introductory ESPN digital offer. And ultimately, when Flagship is launched, people who use the ESPN tile will have an opportunity to subscribe to Flagship right from that tile. And if they do subscribe to it, then it becomes a completely integrated app experience with Disney Plus.
So it is being integrated.
So it's
there
there
it
to
is.
improve, but to do two things, to benefit Disney Plus Hulu, and it's also there to ultimately benefit ESPN Flagship.
Thank you, Bob.
Thanks, Michael. Operator, next question, please.
Yes, sir. Our next question comes from David Karnovsky with JP Morgan. Please go ahead.
Hi, thank you. With experiences, wanted to see if you could provide any color on the Disney Treasure launch, how the early returns look relative to expectations and the read-throughs for the launches later this calendar year. And then just sticking with parks, maybe you could discuss the rollout of Lightning Lane Premier, which I think you recently expanded access for. What type of take rates are you observing on the product, and how is that impacting other spending buckets or the overall experience? Thanks.
Yeah, good morning. Disney Treasure is off to a spectacular start. Certainly, in terms of selling out the rooms, we've done terrifically well. The feedback and guest experience, the high percentage of people are rating it excellent, very much in line with the rest of our ships. And this is just sort of in the initial cruises. So feel terrific about that. As we've said before, our expectation is for this ship to be profitable in the first quarter, and the first quarter it's in the water. And frankly, that is very much our expectation from here going forward. So feel great about that one. Lightning Lane, we're launching that product, but remember, it is a premium product. It is a product that we are learning how to use. So we are marketing it very gently initially. It's very much in line with our expectations, but we are moving slowly with that product in order to make it a great experience, both for the purchasers of Lightning Lane and for the rest of our guests in the park. So feel great about it. It's going to build over time, but it's certainly very much early days.
All right. These are some pieces that we could actually directly fact check. So I wanted to fact check a little bit. There's been days that we have seen that Premier Pass was sold out, be it that they are just finagling the numbers, trying to figure out where it needs to sit.
Yeah.
But that entire statement there just told me that it's not selling as well as we hoped. And so we're trying to figure it out, is what that statement said. On the fact-checking side, though, we can go over to Disney Cruise Line, straight onto their website, look at Disney Treasure. Here's one of the sailings during the month of March. There's still cabins available inside, concierge, whatnot. Another one, inside cabins available. Another one, concierge cabins available. Inside cabins, concierge veranda inside. We get to May. There's every category still available. So I don't know if maybe, again, these periods that we can't see because it's too close, maybe they fully sold out. Halloween cruises are normally very busy. All of those are still open. So I don't know. I mean, they're selling the cabins. And again, for Royal Caribbean, I believe it's only 40% of the ship has to be sold to be profitable. Disney's probably a little bit more because of just the different level of everything.
The higher
pay and
the higher staff guest ratio as well.
Correct. So they are still making money.
Yeah.
The ship looks beautiful. Like, I'm excited to go see it.
And they said that they expected it to be profitable after the first full quarter of it in the water.
Correct. So
which they said they're on track for that.
Yeah, it means by the end of next month, it would need to be profitable. Which that's an awful high fee to see. I guess we'll have to wait to see what happens. But if they are, then cool. That's fantastic for the ship. Again, the ship looks beautiful. Like no criticism to the ship. We haven't been on it yet, so we can't fully criticize it anyways. But it already looks better than the Wish did. So it's just you can't say that you're selling out all of your cruises when you're not selling out all your cruises. You can say we're selling a good majority of our cruises.
I think what he's saying is that every cruise that had sailed up into today had sold out. I can see that.
But I know that's not true either.
I don't know, man.
So
Thanks, David. Operator, next question, please.
Absolutely. And our next question today comes from Michael Morris at Guggenheim. Please go ahead.
Thank you. Good morning. Two questions about your outlook. First, at Experiences, Hugh, on the fourth quarter call, you mentioned that bookings in the back half of the year were positive at that point in time. I'm wondering if you can give us an update there. Are they still positive? Do you have any more visibility? How's that trended? And then my second question is on direct-to-consumer. You had a really strong first quarter. I think you grew about $400 million year.
One could hope. I absolutely hope you're right.
Oh god.
Bob Iger only knows right now how to buy things. He actually has not, in my opinion, made any good, at least in this last section of his career, any good creative decisions. It's just been, this company's profitable. We'll buy it and we'll just do it our way.
When did he take back over?
He took back over.
Has he had a full fiscal year yet? I'll ask you that. Yeah?
When did Bob Iger return to Disney, even though he didn't ever really leave? November 20th of 2022.
Oh, yeah. He's had 2 years.
Yeah.
Okay.
Yeah, because again, the biggest thing was when he came back in November 20th, 2022, the purpose of his returnal was to find the replacement for Chapek and for himself.
Yeah.
And he was going to have 2 years. And then in November of 24, he would have been passing the control over for January to be a new CEO.
Yeah.
He did not pick somebody, which is why we now have a third party being done by the board to go ahead and pick a new person. Kathleen Kennedy, frankly enough, in my opinion, she needs to go ahead and step down because she has destroyed the Star Wars brand. People easily get offended about everything, so I don't blame Disney for play it safe right now. Yes, I agree. But my bigger thing is, and we can just lean on Kathleen Kennedy for a second. A brand that had such a huge fan bases, she kind of destroyed. And there were the writings on the wall there for a while. And instead of acknowledging that, it was, we're doing perfectly fine the way we are, and kept going. Bob Iger, I think Bob Iger at this point is just with the company for a paycheck. Straightforward.
Yeah, probably.
I think if he could, he would just sell and get out of the company altogether and just sell out everything of it and just let it be and just take the money and run. Because at least in this hearing call, because I have listened to hearing calls in the past, this sounds like a defeated Bob Iger. Like think of the Galaxy's Edge announcement D23 when he was on stage and how hyped he sounded. This is not that same man. This is a guy who's at the end of his career. He's done. Yeah. He is so over it.
He's tired.
And supposedly he's going into politics, but who knows? We'll see.
God. We're almost done. We're almost done.
Well, but then we still have to go through some of the paperwork side of it.
No!
Every year on operating profit, and your guide only implies about $100 million a quarter for the next 3 quarters. So can you talk a little bit about what goes into that outlook, what the puts and takes are maybe on investment that would have that growth slower for the balance of the year? Thank you.
Yeah, happy to cover both of those. hitting on DTC first. As I mentioned, it's obviously an evolving environment. Our expectations are for the business to do terrifically well. We made $300 million in the quarter. For the full year, our expectation is to be a little over $1 billion. So we obviously still have some work to do, but we're out of the blocks very, very quickly. As I mentioned earlier in this call, we're certainly not afraid to over-deliver if the business momentum gives us that. But that's something to be seen. It's premature to be thinking about raising guidance, in my opinion, after just one quarter of results. And the second question was, in terms of
back into the
bookings. The bookings. I'm sorry. I should have written that down. Basically, we are further into the curve, but the messaging is exactly the same as I gave you last quarter. Bookings are up in the summer right now, so certainly feeling positive. And obviously, we have more of them in, given that we're 90 days later. So certainly the outlook is good in that regard. But as always, we're going to take a view at this point that it's premature to be changing guide in that regard. But off to a great start in experiences.
Great. Thank you for the answers.
Operator, next question, please.
Yes, sir. Our next question comes from Brian Kraft at Deutsche Bank. Please go ahead.
Hi, good morning. So I had one on sports and then just a follow up. So first on sports, you're obviously going to see a step up in rights costs for the NBA next year, but you've guided to low single digit OI growth in fiscal 26 on top of 13% growth this year. So I just wanted to ask if we should be thinking about some offset and other sports rights coming out of the business to offset the NBA increase, or if the fiscal 26 growth is more a function of OI growth from flagship, or a big improvement in pay TV sub declines because of lower priced small sports and news packages. So just trying to get underneath of the drivers of that strength. And then secondly, just on Disney Plus, if you could talk about the outlook for Disney Plus subscriber growth this year. I think you're guiding to essentially flat subs through the end of 2Q. What are you expecting in the second half of the year directionally, and what are some of the key factors that are shaping the outlook for the rest of the year? Thank you.
Yeah, so in terms of ESPN and the NBA, obviously there are a lot of variables that go into ESPN's P&L, including the advertising market for live sports, which is obviously very, very strong. It's also in terms of aggregate cost management, not just rights costs for the entire business. And Jimmy and the team do a phenomenal job managing their costs, and that's a tailwind. And then in addition to that, we're going to look at everything else that's out there, and we'll make decisions that are reflective of the discipline that I think this team has shown in terms of what we're looking at in rights going forward. So I'll leave it at that. But as I said earlier in the call, we mentioned low single digits next year. We're still very much committed to that based on the aggregate of all of those inputs. In terms of outlook for DTC subscribers, our expectation is to grow them for the year. So given we're basically sort of slightly up in the first quarter, we'll be similar in the second quarter. Our expectation is, particularly as paid sharing starts to take hold, and as we add more of the movie slate that we produced in the back half of 24 into the streaming service in 25, we think that content will drive sub growth as well.
And I'll add to what you said. We actually are very pleased with where we are sub-wise for Disney Plus and Hulu. As you know, we took prices up significantly fairly recently and expected the churn would be significantly greater. And it turned out we delivered numbers that were better than we had expected. So the combination of Disney Plus and Hulu, actually, we grew subs modestly in the quarter. Now,
that being the price did go up, but if anybody who had a year-long membership paid for, they just didn't cancel because their price hasn't changed yet.
Yeah.
On top of that, I believe Verizon's still offering free Disney Plus, so
probably
you still have those people in there also.
We did that. We also are implementing, as we talked earlier, these technological advances or enhancements that will enable us to lower churn and continue to grow subs. And we also have a great product pipeline coming. So we're bullish about our ability to turn streaming not just into the profitable business that it is today, but into a growth business for the company due to the combination of all these things. And that includes the ability to successfully bundle, both for the consumer and for our shareholder, Disney Plus, Hulu, and ultimately ESPN.
Thanks, Brian.
Thank you very much.
Operator, we have time for one last question.
Thank you. And our final question today comes from Kannan Venkateshwar with Barclays. Please go ahead.
Thank you. Maybe on ESPN flagship, Bob, just in terms of the vision that you have for the product and the objectives with that service, is this to basically further grow the sports business relative to where it is today? Or is it more to preserve existing profitability and preserve the ecosystem as it is today? It would be great to get your thoughts on that. And then maybe another one on just the industry-wide consolidation efforts that we are seeing. If there is an effort to roll up cable networks across the industry, would there be any interest from your end potentially to participate in that with some of your smaller networks? Thank you.
Let me just make a quick comment about the linear networks. We actually are at a point where the linear networks at our company are not a burden at all. They're actually an asset. We are programming them and we are funding them at levels that actually give us the ability to enhance our overall television business. That obviously includes and leans into streaming, which, let's face it, is really the future of the television business. So while I won't rule out the possibility some of the smaller networks in some form or another being configured differently in terms of how we bring them to market, maybe even ownership, but we're not right now. We actually feel good about the hand that we have and the manner in which we're managing both the linear and the streaming businesses across the board at Disney. Regarding flagship, look, it's pretty clear that young viewers, I guess you call them, or young consumers, are leaning more and more into streaming experiences, both fixed televisions on walls and mobile devices. And the more ESPN can be present for a new generation of consumers.
Yes.
That doesn't sound good.
No, that doesn't sound good. Instead of it being Bob Iger just said straightforward that I view the young audience not as viewers of their product, but just consumers. More money, more sales.
Yep. And
yes, you're a CEO of a company. You're talking about children. They should only be, your goal with a child should only be that they are going to enjoy the content. Your consumer is the family and the parent. I don't like that one.
Nope.
With a product that serves them really well, the better off ESPN's business is. So flagship is not really designed to preserve a business. It's designed to grow a business in a market that's evolving or changing right before our eyes. So we're extremely, extremely excited by what's coming and bullish about it because we think it's not only a good business proposition, but it's a sports fan's dream.
Thank you.
But do you have the sports fan?
Thanks, Kannan, and thanks everyone for your questions this morning.
Do this.
We want to thank you for joining us and wish everyone a good rest of the day.
Okay, so that was the earnings call. I'm going to jump over to your screen.
Before it.
While I'm taking this, while I'm switching mine around.
What am I going to do?
Oh, never mind. I'll just go to here for now.
Yeah.
Did you? What did you find so far?
A couple things. Let me pull this up. I had something. Oh, here we are. This is for experiences. Yeah. This.
Nope. I just went to go do it.
This quarter, we successfully launched the Disney Treasure, 6th ship in the Disney Cruise Line fleet, and we opened Tiana's Bayou Adventure at Disneyland Resort. As well as the new Island Tower at Walt Disney World's Polynesian Resort. Why?
Why did we build the tower?
Yeah.
Yeah, that's a good question.
Yep. Looking ahead, we are excited to kick off Disneyland's 70th anniversary in May and Hong Kong's Disneyland 20th anniversary celebration later this year. There's another 7 cruise ships in development.
Which would be the Destiny,
Adventure. Do we have names already?
No, but
the
4. The Lawrence Land Company. That's correct.
Yeah. So the new fleet, not the new fleet, the new class.
The Adventure, the Destiny, the Final, the Trident class, which is owned by Oriental Land
I
Company.
didn't know there were 4. Okay, and then the new class
because the Oriental Land Company bought theirs later on.
Okay,
and then the new class of 4.
Okay,
that's what that is.
Okay, that makes sense. I didn't know we were getting 7. That's crazy. They're like genuinely putting money into DCL now.
Yes, because DCL is one of their more profitable areas. We should be able to find it in this charting. They
actually, yeah, we can.
But I think they also are working on. I think they're getting ready to get rid of the Magic and Wonder.
You think they're going to retire them?
Yeah, I think so. They both launched in 98 and 99. I think so.
Entertainment.
While you're scrolling through there,
Linear networks.
Let's take a look at some hard figures, at least according to the Disney Company hard figures. Scare, tire window, and you are the ish window. So
I'm looking for the cruise ships.
The financial results summarized. This is dollars and millions except per share amounts. So revenue, Disney reported in December 28th, 2024, 24,690 compared to 23,549. So that is a 5% growth. Income before taxes, we saw a little income growth there. Let's see, anything special up in this section? Cash provided by operations, we saw 47% growth, which you have to give that. Free cash flow went down.
I don't know what that means.
The total segment operating income, diluted EPS, excluding certain items, and free cash flow are non-GAAP financial measures. The most comparable GAAP measures are income before income taxes, diluted GPS, and cash provided by operations, respectively. My understanding is so free cash would be, if I'm understanding fully correctly, I have my budgets of a total of $1,000 of my budgets over here. Last year, I ended up selling an extra $200 I did not plan on. So this is $200 of free cash. I can use this.
Okay.
If we need a really quick push for a new attraction, that $200 can go over there, and it's not going to affect any of our budgets.
Okay.
That number should not be negative because that means
you're selling less than what you expected.
Correct.
Okay.
Is my understanding.
So obviously the higher any of these numbers are, the better.
So
theoretically.
So first off, do not take any financial advice from us.
We know nothing
at all. Do not take financial advice from anybody on YouTube. Contact an actual stockbroker. Take financial advice there. Putting that out there first. Second, yes, we don't. Neither of us are finance professionals. I do work in a numbers industry for my regular paycheck. But yes, to answer your question, ideally all of these should be a higher percentage because we want more money. That still being said, it says that they still had free cash at the end of it, which is good, but they had less, which means you could take that as an idea that the numbers maybe is starting to skew. Because again, part of your increase of revenue this year is there also was price increases. So revenue is going to go up because everything costs more when people bought it.
Yep.
Do you have something pulled up?
Yeah, something pulled up. This is experiences, but of course they bundle everything together to make everything sound better. So we don't know if DCL is doing well. I assume for last year it isn't because they had 2 ships in production.
Yeah.
And they're stating that as a reason as to why operating income was lower was because of the hurricanes, which Walt Disney World was closed for a day.
Yeah.
And they had to close 1 cruise.
Yeah.
And then higher costs, primarily due to fleet expansion. Which I get, because they had two fleets, they had 2 ships in production.
Yes. But I will say, the cruise line is not that big of a pull on the company.
I know.
So that's a little tricky way of saying that things are better than they actually are.
But even then, like, overall, these numbers are higher than last year.
True.
These numbers are higher than last year.
True.
By a small margin.
Still
up.
True.
Go ahead, take stage. If you got something queued up.
Yeah, I'm trying to pretty much go back and forth while we're going through these. When we're looking at the revenues and the different parts of this is the summarized segment financial results. So entertainment did come up.
Mm-hmm.
This is going to be then we have sports. Sports did nothing for the company. Straightforward. Didn't go up, didn't go down. It did nothing. Experiences did bring in some extra money this time. Eliminations. That's number 1. So
reflects fees paid by Hulu to ESPN and the entertainment linear networks business for the right to air their networks on Hulu Live, and fees paid by ABC and Disney Plus to ESPN program certain sports content on ABC Network and Disney Plus.
So that got more expensive this year. That went up from $3.99 to $4.47. That went up 12%. Which that's a pretty good jump.
Yeah.
The segment operating income, entertainment
jumped 95%.
Which I'm not sure how. Sports, I don't know what they mean by NM, so I don't know what that's referencing.
And experiences had no change.
Yeah.
Entertainment hard carried this year.
Yeah. Well, segment. Quarter.
No, this is year.
Well, that one is year.
This is year.
No, that's quarter.
No. December 28th, 2024.
The following table summarizes the first quarter segment revenue of operating income for the fiscal 2025 and 2024 year.
Yeah, it's comparing this first quarter to last year's first quarter.
Correct.
Okay. Oh, yeah. Yeah.
It's not the whole year. That would be that'd be like right before November. That's the big one that everybody really watches for. This one is just trying to see what's going on. Direct to consumer, slight increase on revenue. Operating income / lost is 293 to 138, so it's just slightly increased. Well, actually, pretty good increase. Disney Plus. Okay. Domestic US and Canada, the change was a total of 1%.
1% up.
1% up.
But 1%.
1%. Internationally,
it's 2% down.
Which leveled out Disney Plus total at only negative 1%. So again, part of me wonders how much of that is that $2 special they were doing, and how much of that is
the price hike and all that.
So that's interesting. Hulu, SVOD only.
It's just video on demand only. So no live TV.
So that's the free one. That's the ad one.
Yes.
That increased 3%. Live TV plus
live TV didn't change.
Live TV didn't change. So it shows more people want to pay less.
Yep.
I agree. Total Hulu, a 3% change because of the non-paid.
Average revenue per paid subscriber. Okay.
Because this was the price increases.
Oh, yeah.
So per person, Disney Plus now costs 4% more than it did last year domestically, 6% more internationally, which increased their income of it by about 5% total.
Yeah.
Again, SVOD only because there is that little paid section, so there didn't change at all. And even though they did not gain subscribers, that means they just increased their pricing.
Mm-hmm.
That's what that is.
Increases in pricing, yeah.
Yeah. That's all that is.
Yeah.
Sorry, I'm trying to still keep an eye over there.
On what?
Chat.
Oh.
Did we talk ESPN?
Not yet, no.
ESPN. Domestically, it came up 9%. Internationally, it came up 7%. For a total change of 8%. Star India, it lost 90%. What is Star India?
I have no idea.
Oh, the largest television entertainment network in India.
Okay.
So they pretty much lost their Indian market, is what that said.
Yeah.
And supposedly it did not affect their income at all.
I mean, when you look at the numbers, it didn't.
Correct. ESPN income / loss dropped 9%. Domestically, it came up 95% technically. Still a loss.
Yeah, it's still a loss.
International came up 15%.
No, that's total. Total came up 15.
Oh, total came up 15%.
International came up 95.
Yes.
Yeah.
Again, this is nothing. This operating income for ESPN and Star India, this is absolutely nothing compared to like the rest of the Walt Disney Company.
The improvement of Star India's operating results reflected the comparison to the ICC Cricket World Cup in the prior year quarter, as there were no significant cricket events aired in the current quarter prior to Star India transaction. So what they're saying is because there was nothing on, that's why Star India lost money. I guess. That's my understanding of that.
That'd be my understanding.
Okay.
Right there where you scroll down into paid subscribers.
The millions. Change of 3%.
Negative 3%.
What is this for? ESPN Plus.
So they lost 3% of their subscribers.
But their monthly revenue went up 7% because I assume price hikes.
Yeah, because it went from 5.94 to 6.36.
And then here's experiences, which we went over already. Other financial information.
Interest expense, equity and income. Let's see. Let's try to find anything that is actually interesting to talk about.
Equity in the income investees. Yes, no?
You can go through it. You're right. It's on your screen at the moment.
Amounts included in segment results. So entertainment, they lost 31,000. I don't understand what this means. Equity in the income of investees.
Shares is what I would assume.
Okay.
Because investors would be your shareholders.
Yeah, so they lost 49%.
I mean, they've not had a very good year in shares and such.
Yeah.
Like, there's the year.
Yeah.
There's 5 years.
Yeah.
So, I mean...
Where's pull up the year? Where's July? Where's June? I'll put that.
1 year. So there's July.
Really?
There's June. It was higher up in May because this was before the proxy battle. And then the proxy battle happened, and then it plummeted.
And then all the shares plummeted. Yeah, that's why. Okay,
because it didn't. Because
and then what's
Disney won in the proxy battle?
What's the mountain? Moana? November?
No, that's Inside Out.
What is that?
November 15th.
No, that's Moana.
November 12th and such?
Yeah, that's Moana. Inside Out was June. Inside Out came out before Deadpool Wolverine.
True.
Yeah, that's Moana. Yeah.
There's the 5-year.
Yeah.
This was the Chapek time.
It wasn't. They weren't spending money.
No, they weren't spending money. They were making money. And then they stopped.
Yep. Let's see.
Go back to yours.
Capital expenditures, investments in parks, resorts, and other properties were as follows.
That's the one I was working my way down to.
Yep. So we invested less money into entertainment, and 1% more in sports, or $1 million more in sports.
Yep.
Experiences, whole heck of a lot more. They don't have a change over here because they don't want to admit this one. Whole lot more experience wise, and
a lot more international.
Yep.
And corporate went down.
Corporate went down. Good.
And total investments, it went way up.
Almost doubled.
Yeah.
Due to higher spend on cruise ship fleet expansion. Sure.
I mean,
experiences wise, yeah, actually that lines
at
up.
this point, I have to kind of give it to that because, frankly enough, what did the Disney company actually do last year?
Experiences wise, Tiana's.
I mean,
yeah,
but a lot of that fees.
A lot of that is actually pretty cheap. Yeah.
Again, it was $100 million project that was started the year before, so they may have put that money on the year before.
Yeah, you're right. You're right. Yeah, yeah. Or maybe this is what construction's going on? Never mind, nothing.
Yeah, the company's not doing anything.
You're
so
right. Yeah, so that has to be cruise ships then. Depreciation expense. I don't know what that means.
Depreciation, assets that they bought. So technically a ship should be a depreciated expense. This is something that cost me $100 million. I know I'm not going to get my money back on it for at least 5 years. So I'm going to depreciate its cost of it over the next 5 years in order to go ahead and make my taxable income lower.
Okay.
So you're a business owner right now, okay?
Yeah.
We're gonna throw it on to me for a minute. You're a business owner. Your entire business you do on just your cell phone.
Yeah.
You decide that you don't want to use your personal phone for your business, so you go out and you go buy $1,000 cell phone.
Mm-hmm.
That phone is 100% write-offable on your business.
Yeah.
However, that expense of that $1,000, you can either take the 100% of the expense this year. So let's say you had a really good year and you made $2,000. So you take the entire expense this year. So profitability, taxable wise, you're only taxable $1,000.
Okay.
Or you didn't do as good this year, so you're going to take this $1,000 and I split it over 5 years.
Okay.
And so that I can now write off this cost of this phone for the next 5 years. But you don't get the full $1,000 at once.
You write off 200 of it each year. Okay. Okay, that makes sense actually.
Okay. That was the basic explanation of
No, that makes sense, yeah. So depreciation is about the same as last year.
Yes.
A little bit more. Which that's what you would expect.
Since right now the company's not doing anything.
That's what you would expect.
The only reason why it should have come up was because, again, technically,
because the treasure,
I feel the ships should be being put as depreciable expenses, but they may.
It is 10% higher.
So that's probably your treasure right
there. Which makes up over half of the change here.
Yeah.
Yeah. So yeah, I would expect it to be the treasure as to why that's up. And then what is this?
These are the condensed calculations. It's what I'm running through right now. I'm trying to find anything.
Okay, so probably not.
I mean, it's kind of going over what we did go over.
It's just far more condensed.
Yeah. Anything on this one I want to... Nah, we can skip that one. And then you... So...
Overall, total equity, it's about the same.
Yeah. This was the prepared management remarks.
Nitpick this a little bit. Not really anything exciting to talk about, honestly.
Well, yeah, because again, we're not afraid of Epic Universe. I mean, the next hearing call is going to be the big important one to listen to.
Yes,
because that's going to be the one Epic Universe will be opened.
Yeah.
I'm really curious to see. I need to find. There was a travel agent who was talking about the actual changes in the booking schedules and such that they were seeing.
Mm-hmm.
I need to find one of her videos because Bob Iger is making it sound like they're selling a lot more than she was selling under travel agent, and they can see how many rooms are available. And as she put it, there's a lot of rooms available this year at Disney than there were in the past.
Mm-hmm.
With multiple consumer touch points, we continue to generate ongoing long-term value from our theatrical releases, and we now have more ways to leverage film success than ever before. For example, Moana film franchise, with a live-action film currently in development, is approaching $1.7 billion at the global box office, underscoring the strong and enduring connection that audiences have with the stories and characters, and further validating our strategy of investing in popular IP. The original Moana animated film has crossed 1 billion hours streamed on Disney Plus and was the most streamed movie in the U.S. on any platform for the second year in a row, which is true. Moana also continues to delight guests across our experiences, businesses, with its most recent addition, the Tale of Moana on the stage show, A Disney Treasure, which looks actually pretty good. Television series have also continued to demonstrate immense popularity. So, new television shows that came to Disney Plus would have been Agatha, Acolyte. No, Acolyte was last year. So Agatha.
In quarter one?
Well, they're just referencing anything in the last year.
Skeleton Crew.
Okay. So our television series have also continued to demonstrate immense popularity. In calendar year 2024, we have the top 4 most streamed shows in the U.S., led by Bluey. You don't own that. You just have the rights, with more than 55 billion minutes viewed. That's correct because it's Bluey, along with Grey's Anatomy,
Yep,
Family Guy, and Bob's Burgers. So, one of which you pay for the rights of.
3 of which.
No, the other 2 they own the company now. They bought
Oh,
Fox,
yeah, huh?
but it's not that it's new products of it. It's just they own it.
Yep.
And Grey's Anatomy, it's probably most people binging all the old seasons.
Yep.
In addition to resonating with audiences, our films and television series have garnered numerous critical accolades. We won 6 Golden Globes awards across the content. Yeah, whatever. They won awards. Streaming remains a success story for the company. Okay, that's a choice. Into the ultimate digital destination for audiences to access the very best we have to offer in film, television, sports, and news. And our quarter one entertainment direct-to-consumer results reflected improved profitability. That doesn't mean improved consumer, but improved profitability, with nearly $300 million in operating income, representing an improvement of more than $430 million compared to Q1 last year. We expect engagement with the platform to grow over time, given the global strength of our content and our focus on platform enhancements, including well-received, most well-received recent improvements like prominently showcasing our top 10 series and movies, implementing further personalization features, and offering streams. Our provided playlist on Disney Plus that launched at the end of September.
Oh, this came out?
Apparently.
Where was the marketing?
Such as high-interest live news events. Woo! The focus on platform enhancements remain on one of our top priorities as we continue to expand. Please remember, you are not a tech company. You are an entertainment company. In December, we introduced an ESPN tile on Disney Plus. ESPN. We already saw your numbers up above. ESPN did not do what you're promising it's going to do.
Mm-hmm.
More sports. ESPN's flagship offering that will likely launch in early fall has been and remains our priority. And we expect the elevated product and content experience, which will all be housed within the ESPN app, will be digital destination for sports fans alike, unlike anything available in the marketplace today. With the full suite of ESPN's network and ESPN Plus and highly interactive and personalized features. As we've seen, live sports have the power to convert enormous audiences. The 2024 season Monday Night Football was ESPN's second most watched in the company's 19-year history of airing the storied NFL television franchise. What? So the entire season was the second highest? I guess so. Meaning that there was a season that did better in the past than current seasons. In addition to professional football, fan interest in college football continues to grow. That is true. This was our first season broadcasting the entirety of the SEC schedule, contributing to a strong rating across our college football program.
Wait, they didn't broadcast the whole schedule?
They didn't have the rights to. They bought the rights for it.
Oh, okay.
So that is true. That was an increase. It's what everybody's waiting to see after now the football season's done. How much of a drop off is there going to be? Because a lot of people were watching it because of college ball. Experiences.
We went over this.
Yeah, you read these ones. Financial review and outlook. Is there anything in here? Okay. Content sales, licensing, and other generated more than $300 million of operating income in quarter one, which is consistent with the guidance we previously provided and reflects the strong performance of Moana 2 compared to an operating loss of $224 million in the prior year. Okay. So they pretty much in the last 2 years have broken even.
Yeah.
Let's see. Direct to consumer grew by approximately $430 million, approximately $300 million due to growth in subscription revenue, partially offset by higher technology. No, it's offset by increased costs to consumer. Direct consumer advertising declined by 2%, excluding the impact on Disney Plus Hotstar service in India. Direct-to-consumers ad revenue was up 16% for the full year fiscal 2025. We continue to expect direct-to-consumer operating income to increase to approximately $875 million versus the prior year. We ended quarter one with 178 million Disney Plus and Hulu subscriptions, which is an increase of 0.9 million compared to quarter four. Disney Plus subscribers declined by 0.7 million the prior quarter.
Okay, so they went up actually. So comparatively to last year, they're down 700,000, but comparatively calendar year, they're up 900 from where they dropped.
Yeah.
Okay.
There's some weird numbering going on in this section. Linear networks, sports, experience revenue, quarter one, 3%, grew 3%. Operating income was comparable to the prior year quarter. Growth in international parks and experiences operating income was offset by decline in domestic park and experiences. Because you put all the money in the international, and now it's catching up to you. Quarter one results reflect the adverse impact of the Hurricane Milton and hailing, which it did. Oh wait, it did impact in the fact that there were people that did not travel because of it. It did not impact as much as they are leaning on it.
Yeah,
they're using it as their scapegoat. Quarter one results reflect the adverse impact of Hurricane Milton and hailing of approximately $120 million. Yeah, no.
No.
And approximately $75 million of pre-opening expenses driven by the launch of the Disney Treasure. I don't know how much those ships cost, so maybe. Which aggravated drone an estimated 6% point headwind to the year over segment.
Sure.
International parks and expenses operating income quarter one increased 28% compared to the prior year. So internationally they went up. Domestic parks and expenses operating income declined. See, here's the bigger part. The domestic parks operating income declined by 5% compared to the prior year quarter, driven by higher costs, including the fleet expansion and lower attendance, reflecting the impact of the hurricanes, partially offset. You don't drop 5% because of a hurricane.
No.
I'm sorry to tell you. For the full year, we expect the total operating expenses related to Disney Cruise Line expansion of approximately $200 million, including roughly $40 million in quarter two. So yeah, okay, that math kind of checks. Because they said that part it was pushed back $75 million because of Disney's Treasure. They have to pay off the remaining balance of the Adventure and the Destiny. They're saying about $200 million for that. So
Okay.
that math, I'm okay with that math. That math seems to check. For fiscal 2025, we continue to expect full year segment operating income growth to be in the 6 to 8% range compared to fiscal 2024.
I think that's it.
I think that would be it. So, what do you think? What's your thoughts?
Oh, I don't like this. Oh, ew. There you go. It's about the same as last year. Just a little bit up overall.
Which I'm surprised by. I mean, I've seen the crowds out here really haven't changed. But everything I'm seeing for Florida, like wait times and everything,
they're all down.
They're all down.
Mm-hmm.
Which is why there's something funky in the numbers.
Well, I think everybody's holding off right now.
Do you think? Okay, let me reword this. Then I was going to word it. We do know with Epic there will be more traffic into Orlando.
Yeah.
So, do you think Disney is going to see a loss of attendance, no change, they're going to stay right in the middle of the road, a 2% growth, or more than a 2% growth?
I think like a 2% growth.
I think like a 2% growth. Because you're going to have those extra strands and extra bystanders that are going to make their way over.
Mm-hmm.
And so they are going to have a better year than last year because they had a really bad last year. They just don't want to seem to talk about that in this whole thing. Do you think that 2% is going to save them? Like so sure it's going to.
It's going to save them. They're fine. They didn't lose anything.
Well, no, but again, they're trying to convince all their shareholders and such that this is the right case. We're going to be totally fine, and we're going to just come right through this without any problem. That's what I mean by save them.
Okay.
Or do you think that fans are going to be questioning where this extra income is? I mean, again, when we look just straightforward, this shareholder call did not help them today.
No, I was looking at it on the website too.
This tells me that the fan base that has shares in it, I personally do not. I just never bought any. That they're nervous, they're scared.
Mm-hmm.
Do you think that 2% is going to ensure them and make them feel confident with their money being sat with the Disney company?
I think so.
Do you think that 2% is going to offset whatever losses are going to happen at the box office this year?
No.
Okay. Yeah, I don't think so either, because I will still sit there on my high horse. I think Lilo and Stitch is going to do very well.
I think Lilo and Stitch is going to do well. I think Fantastic Four might do well.
I think Fantastic Four is going to do solid.
Yeah.
I'm not going to say well.
I think Captain America is going to break even. I think Thunderbolts is going to flop.
Thunderbolts is going to flop. I'm like 90% sure of that. Captain America.
We'll see, because
it depends on how much these last quick reshoots that they jumped back into, how much those cost them.
Yeah.
I think they're either going to break even overall, which of course we're never going to fully know because they're never going to admit how much they spent on marketing.
Yeah.
And they're spending a lot of marketing. This thing is showing up on my ad feed at least 6 times a day. So it's either going to go ahead and it's going to break even, but I think it's going to be more so. It's going to get within 1% to 2%.
Yeah.
I think it's going to come in right below where they need it to. So it's not going to be a big loss and big burden to the company, but it's not going to be needing what they need to do.
Yeah. I agree.
What is their Inside Out 2 and Moana 2 this year? I think Lilo and Stitch.
Lilo and Stitch. Maybe Fantastic. There's a lot of competition that month, though.
There's a lot of competition. I think
also that helps them as well.
I think Superman's going to pull too much of it.
You think so?
I think so.
Well, they're also coming out 2 weeks after Superman.
That is true.
They're coming out after. So
that can help or it can hurt.
Yes.
Because if it comes out that Superman is so fantastic and so amazing, it may hurt its viewer.
Yeah.
I think it's going to come down to if Avatar stays on schedule.
If Avatar stays on schedule and releases this year, definitely.
I think it will be enough to offset.
And I think they're going to push not to delay it. So
we just haven't heard anything.
It was at D23.
Yes.
We didn't see anything.
We didn't see anything, but they said that it was coming out this year.
Yeah.
It's kind of nerve-wracking they already have the nice thing is they already have all the character models designed of all the main characters. So it's just whatever new group they're going to.
Yeah.
And miraculously, all these characters look very similar except for different body tattoos. So easy update there.
Yeah. So yeah.
It should be an interesting year.
Yeah.
Is the 70th going to help it?
We'll see. Did the 100th help?
The 100th was a mess. The 70th right now doesn't look like it's going to be too much more helpful.
They're going pro-consumer on the 70th. I can tell you that much.
No, they're going, please come back to the parks.
You're damn right. And you know who's back in the parks? Our dumbasses.
Yes. Yes, because, again...
You're getting the best fireworks show and the best nighttime parade? Come on, bro.
Grab. Yeah, so we got going on. I like the castle. This is a nice subtle design.
Yeah.
I like this. I mean, that's enough reason right there to come back to the parks.
Yep.
But then this is going to be an absolute nightmare in the park. In
Oh
Disneyland.
yeah.
Having Paint the Night and
Wondrous.
That's going to be god awful. I'm going to hate it.
But we're going to do it every day.
I'm still curious about this, especially right there.
I forgot we're getting a new one.
You see what's right there?
What? Wow. Is it focused on animation? I can't tell.
So the World of Happiness is that one above or below. At Paradise Bay, this is coming from my website that I don't update very often. So monkeybloggers.com. World of Happiness at Paradise Bay, the World of Color Happiness Nighttime Spectacular explores the emotions of joy, hosted by Joy and Friends from Inside Out, with breathtaking fountains, lasers, flame events, and music from films like Tangled and Lion King. The show promises to immerse you in a kaleidoscope of happy emotions. And straightforward. I mean, so we get the boy band from but
Down.
This is eye to eye. We're
Yeah.
getting eye to eye in a show. I don't care what you have to say about the rest of it. This is Scar during Be Prepared.
Yeah.
Like if we get even those two sections alone, the show's a banger. The show is hands down a banger. I don't understand why this parade's coming back.
Better together, George. You, me, we're better together.
I don't understand why this parade's coming
Better
back.
together.
Because I don't even. I mean, it did okay.
It was alright,
but it really didn't pull that many extra people. I think it was just we need something for DCA besides World of Color.
Yep.
Plus, we know the we're getting the Walt Disney animatronic.
Yeah,
that's not part of the 70s. That's just happening. So I think that's gonna. I think Disneyland is going. This is really sad to say. I think Disneyland is going to be the park that carries the company for the next year.
That's funny.
Because what is there in Walt Disney World besides walls?
The Communicore. And falling ceilings, George.
And falling ceilings. We talked about that. But like, you got Big Thunder under walls until next year. The Rivers of America are going to be closing here eventually, so that entire section of the park is going to be walled off. And besides opening bars and in winter Zootopia, that's it. So I don't know. It's going to be an interesting year for the company. It's going to be an interesting year for us too, because we're working on growing.
Oh, yeah.
You should help with that by liking and subscribing. Being sure to check out the normal Pop Culture Jungle podcast, which happens every Tuesday at 6
p.m. PST.
That's correct. I was questioning if I was remembering the right time.
Yes.
I have to
Spider-Man's at 5. That's why you got confused.
Yeah. Yeah. So for the next 2 weeks, if you're around, every Wednesday at 5 p.m.
We got 2 more episodes.
We're jumping into Spider-Man. In 2 weeks, will be a longer one because we're going to do kind of a recap of the whole season and our overall opinions. Right now, we're kind of on a little bit of a downward line.
Still good.
It's still good.
Still good.
But we're a little bit down. We're hoping to see that peak come back up because we got to hit that high point at the end of the season. We'll get there. Who knows? Will you join us? Absolutely. But until next time, see you later.
Bye. Oh, I could hit the button, huh?